All right. Thank you guys, everyone, for joining us. Everyone here in person and at home as well. Welcome to FIP's economic forecast for the first quarter. Glad to see you all here. My name is Victor Dean, and I'm really glad many of you are here today, all of you. We have a great program planned today, but before we jump in, I'd like to take just a minute to share a little bit more about who we are at Financial Independence Planning. For more than 30 years, FIP has helped individuals and families make smart retirement and financial decisions. Today, we are a team of 21 professionals who are dedicated to delivering the best and exceptional client service to all. What originally drew me to FIP and what keeps me excited to be part of this team and this family is our mission. To help people worry less and enjoy life more, in case you've never heard that before from me. And have the confidence in your financial futures as well. So to have the great business we have today comes from a strong leadership team and structure. Harry and Jared Keller have set the precedent of putting families first, curating an unbelievable experience in helping clients live more fulfilling lives. So with that, it's my pleasure to introduce Jared Keller, CFP, President and Senior Financial Advisor here at FIP. Jared's been with the firm for over 16 years and has grown through multiple roles, from client services to senior advisor, manager of new business, and now president. His experience and leadership have helped shape the firm into what it is today and the direction that we'll be going forward to in the future. Jared?
Good job, Victor. For those of you who don't know Victor, he's one of our financial advisors. He works with many of our clients. He's going to be a CFP also. He's putting in a ton of hard work by the summertime. Working with him has been an absolute pleasure. And if you haven't met him yet, take some time to meet him. He's a great advisor and a great guy. You know, it's funny. Being introduced is bittersweet for me. Many of you have been with our firms for so long, and of course, my dad, works around the clock still, but I spent years introducing him, and to now be introduced, it's cool, but it's like, man, I remember the days I was coming here, setting up the whole thing, greeting everybody. Dan Brady, remember, running around this whole thing, to now be able to do some of these introductions. So as I said, it's always such a pleasure to be able to talk, to you guys. Running these events is really important for us because, again, it's part of our great experience. It's not just the service we deliver, but it's these great experiences we can provide. What do? I'm not gonna. Back in the day, I used to have a whole script, and you guys know what we do, but I think about it pretty much every day, and my team knows that. And what we really do for our clients is empower you to live a more fulfilling life, right? So you can worry less and enjoy life more. We just do that through financial planning and confidence you're on track to your long-term goals. So I just want to touch a little bit on, why are we here, right? Economic forecast. What's going to happen this year? Our goal and what we do is the market's always up and down. We have a lot of really smart people talking today, and the reality is who knows what's going to happen. Our mission for our clients is to help you worry less and enjoy life more, but it's not only when the market's up. Regardless if the market is up or down, our process is empowering you to know you're still on track to your long-term goal, regardless of market performance. And how do we do that? We use one of the top financial planning softwares all of you get to see, right? And you see that regardless of, every year the market changes. And what do we focus on? What's that average return you need to maintain your assets? And purposely, we run those returns reasonable or conservative, 4 or 5%. Because when there is volatility, I need you traveling. I need you going to your favorite restaurant. I need you saying Christmas is around the corner or whatever holiday we celebrate, and I got to get all of those gifts. And in 2022, which was a very challenging year, we still had great calls with our clients. And that's not a great year for an advisor, right? Oh, I gotta call my client and stocks and bonds are down. That sounds fun, right? But when you have such a strong process as we do, looking at your total financial household in one of the top financial planning softwares and giving our clients confidence, regardless in this challenging year, you're still in amazing shape. Book the trip, get the gifts. That is how, regardless of what happens in market volatility, we empower you to continue to have these great lives. And also confidence in your in your future. A couple more things that I won't talk too long, and obviously I always end up doing them. Where I feel tremendously confident is, yeah, we celebrated our 30th anniversary last year. Shout out to my dad, I was talking to my friends about this. Townhouse basement, right? Not a lot of resources, just a lot of hard work. But think about over the last 30 years, the volatility that the market's experienced. Significant. 30 years, the tech bubble, 3 negative years. I can't imagine that had to be really tough, Dad. In 2008, 2022 and COVID and globalization, we feel everything. And our firm, through 30 years of unpredictable events, this has never happened before. That's my favorite line. It's always never happened before, right? The world's continuously changing. But through those 30 years, we kept prudent investments, diversified strategies, risk tolerance, time horizon tailored to our clients' objectives, actively monitored and reviewed those, and helped people stay on track to their goals. That is why I'm continuously confident about, regardless of what happens in the market, is FIP's done this. Maybe not this year. I think this year probably, hopefully, be a good year. I don't know. But when there is volatility, we're always ready for this. And your portfolios are tailored to your personal risk tolerance and time horizon, and they're ready for that as well. So for 30 years, we've done it successfully. My last part, I know I've already gone over. When I think about investing, year to year, it can be overwhelming. What's going to happen this year, right? Usually it's trends. And my goal, and I don't say this to like be in front of you and be rah-rah, our goal is to say, how do we help our clients have the best life? Because there's going to be volatility, but I need them to be okay. I need to deliver on my promise of empowering them to live the most fulfilling life. So here's a couple things that I hope I'm not taking away from your president. Is this mic a little fuzzy? Is it okay? Okay. I can talk loud. Trust me, I don't even need this thing. But what I want you to think in volatile times today, you're going to meet with your advisor, you're going to look at your plan and say, hey, our start date is still fine regardless of volatility. Here are some numbers that I personally love that give me confidence. And this is just back from 1950. I didn't cherry pick this time period. There's no like, oh, well, run at a different time and it's different. But this is what I want you to think about in any volatile market, right? Because it's bigger trends, year to year, up, down, again. Since 1950, half of those years had a 10% pullback at some period of time. So 75 years, at some point in that year, the market went down 10%. And again, the market could have been up 15 and jumped to 10. So it's just a 10% drop. Okay, so that's not uncommon at times. 25 of those 41 years, the market still ended positive. So as we've experienced, sometimes that 10%, there's been years the market is down 10 or 15% in April, and we've still had a positive year. So a volatile start or a volatile period doesn't always mean negative. On average, and we're going to experience volatility together, and that's okay. On average, every 10 years, 3 of those years will be negative, right? So negativity or negative times are normal, and we can discuss how it's good for the market, right? It helps reset things a little bit. And once every 7 years, and this is historically, nothing I'm saying is guaranteed, of course, the market has a bear market, 20%. So remember, like in 2022, or when there is some volatility, it's normal, right? It's not always a catastrophe. Most importantly, when you're looking at your plan, are we still on track? Because year to year things change. That's okay. What's our since start date? What's our average been? And look at the majority of all the clients we meet with, your since start date, that real important number, as year to year things change, looks great. And again, since 1950, significant volatility, all sorts of 20% drops and all sorts of 10% corrections. The S&P has still averaged 11%. So again, that's 100% in equity. But my point in that explanation is there's going to be volatility at certain times. I think they're going to give us a great forecast for this year. But this is an education part, and when there is volatility, how I want our community to. We know this is normal. We know FIP is by our side. We know they have a very prudent investment philosophy. We know our accounts are tailored, and we know they do those regularly scheduled calls to constantly make sure our portfolio and our financial plans are on track. Okay, I'm done talking. So we have a tremendous speakers today. Are you first? Yeah. Okay. Brian Roach from Fidelity. And it's interesting. I could sit here and say how Fidelity is our competitor in a sense, but Fidelity is unbelievable. They have great investments, great investment teams, and tremendous knowledge. They're not our competitor, they're our ally. So we use many Fidelity investments and their research and their knowledge to be part of our diversified portfolio. Brian's going to introduce you to a lot of that research. So without further ado, Brian.
Okay, it says 2025, but it is 2026. So this information is current. I'd say I'm on calls with our investment folks at Fidelity on a weekly basis. So I'll give you some color commentaries. I go through some of these slides. But before I get into this, first of all, thank you all for coming today. Thanks for having Fidelity be part of this event. I've been working with this team now for about a dozen years. I will tell you, you're in very good hands. I've worked with advisors throughout this entire region. To get me to show up on a Saturday in an event is a task. So I do it for really good teams of good advisors that really have their clients' best interests in mind. So you're with a good group of people, and I can't underscore that enough. So Jared had mentioned some statistics about volatility, corrections. What's kind of interesting here, this presentation is going to be a little about market history. It's going to be a little bit our forecast for 2026. But this is a quick snapshot more recently. This just goes back to 2018, so like 7 years of the volatility that we've experienced. And it's been greater than we've experienced in the last, say, 75 years, since 1950, as Jared had mentioned. We've had 4 major corrections, 420+% corrections just in 7 years. So it feels like volatility is really on the upswing. The reality is it's always going to be with us. In Fidelity's viewpoint, volatility creates opportunity, and that's not just some sort of saying. We need volatility at Fidelity for us to be able to go in and buy ideas when to get cheap and things get more attractive to us. When things just keep on going up and up and up, we have to back off a little bit and wait for the valuation to get more attractive. So these corrections, these short-term corrections, are very, very important for us, and we need them. But despite these 4 major corrections just in 7 years, the market's up 145% during that time period. And that's the power of the market and the power of compounding and the powering of long-term investing, which this team certainly subscribes to. So it's very important to keep the long-term in mind. Jared had mentioned some statistics about corrections. We have another kind of way of looking at it. It's basically giving the same statistics, just in a different format. You can expect as an investor to get 3 corrections of 5% or more per year on average. This goes back again to 1950, same time period. 1 correction of greater than 10% in a year, 1 correction of 15% once every 3 years, and then 1 correction of greater than 20% once every 5 years. I just mentioned to you, we just had 4 in 7 years, so it's been a lot more recently. But in order to get that average annual return of 11% since 1950, you've got to be in the market, and you've got to be able to endure those down periods. The batting average of the S&P 500. So how often is it up over time? It's up 75% over any rolling 1-year time period. I mean, those are the best odds you're going to get. So being in the market, staying invested, not reacting to short-term news is critically important. And these statistics kind of speak to that. So there are three scenarios I could paint here. A pessimistic scenario, kind of a muddling along one, a resilient scenario, or an optimistic scenario. Fidelity is taking the stance of taking the optimistic scenario here. We don't always do that. But we really think there are things lining up right now that should do very, 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 very well for the economy. I'm going to hit on a couple of those things as we get through it. There are always risks to everything, right? We have to make some assumptions and make some calculations in terms of how we see things playing out. And there's a lot of news and there's a lot of moving parts to this. But when we really boil it down to the fundamentals and the economics, to us, it seems like a very, very good economic environment, which I'm going to touch on. We believe at Fidelity that earnings growth is actually reaccelerating in the United States. Hard to believe because we're coming out from a couple very strong years of earnings growth in large cap companies, S&P 500 companies in the US. We think inflation, although a bit elevated, is healthy. Our viewpoint is long-term average for inflation is closer to 3% over long periods of time. The Fed has kind of put out this goal, this bogey of 2%, which frankly, in Fidelity's standpoint, we don't think is realistic. It's never really been realistic to have 2% inflation. You actually want inflation because it allows companies to grow, to charge more, to create more profit. And that's ultimately what drives stock prices, but it can't be too high. It can't be so high that it inhibits us to spend money and so forth. So we actually think we're in a good spot right now with inflation where, yes, prices are elevated. The way inflation is calculated, it's the year-over-year growth of prices. Those prices aren't coming down. So don't think when we say inflation's getting back to normal that prices are going to come down. Prices are where they're going to be, but they're going to grow at a slower pace. And we think wages and people's assets and wealth will grow at a greater pace to be able to offset that. Labor market, that's going to get a lot of news in terms of new jobs that are created and how healthy is the employment picture. Fidelity has a particular stance on this one. I think we might get into a little bit later in the presentation, but we just don't think we need as many new jobs created every month, which might be a controversial statement. But the reality is we have an aging workforce that's retiring at a very, very rapid rate, so that labor force is actually shrinking from that standpoint, which makes labor still pretty tight. And we have basically zero immigration. So without immigration and without labor force staying employed, it keeps the balance between labor demand and labor growth fairly tight, which is good for people that are working. Wages should gradually go up over time, but they shouldn't get too hot. That'll last for a while. At some point, our population needs to grow. We can't keep on, families can't keep on not having kids. Yeah.
Sorry, the slides also are in your packets.
Okay.
I apologize, I was supposed to say that, but the slides are also in the packets if you want to view them while you go.
Sorry, I know this is a very hard to read. It's hard for me to read. I'm right here. Anyway, you get it all out. It seems as though, in our view, the economy is fairly strong. Labor market is fairly strong. Corporations are doing well. And I'll get into some other specifics here. So we look at the world in terms of the global business cycle. So it's really simple. So it's early cycle, mid-cycle, late cycle, recession. That pattern historically just kind of repeats over and over and over again over time. So the trick is sometimes trying to figure out where you're not on the graphic, as opposed to exactly where you are. We know we're not in a recession. We know we're not coming out of a recession. So our viewpoint is we're probably somewhere between mid and late cycle, which is good. That's a good investment. That's when the economy continues to expand and grow. At some point, the economy will start to slow down, and then eventually we'll have a recession. So to cut to the chase, Fidelity is not forecasting a recession in a forecastable future, like meaning next 18, 24 months. We don't see it. We think the economy is too strong. Certainly things could derail that, but the way things are set up today, we actually think the economy is quite strong, and we don't see a recession in the forecastable future. It doesn't mean we can't have market corrections. That's different. But from an economic standpoint, it seems as though the economy is doing quite well. And the other point I'd make here, it's a little hard to tell in the graphic. There is no country in the world that we've identified, a major economy, that's actually in recession right now. China's one that's probably kind of teetering on coming out of recession, which is important because they're so large and they're a huge global consumer and producer. But we don't see any major economy really in recession at this point, which is a good thing from a global standpoint. It means more growth around the world, more growth here in the United States. Temperamental little clicker. Hold on. Might just do this. Oh, don't mess it up. Here we go. Okay. So I mentioned inflation in terms of how we're looking at goods prices and so forth moving forward. Inflation, I think the last check was like 2.7, 2.8. I think it's the last number that we put out as an economy the report. We at Fidelity actually believe inflation might tick up a little bit next year. So I mentioned that we think inflation is okay, but we do expect it might tick up a little bit. That's mostly goods inflation. So housing we think will kind of moderate, and services should come down a bit. Goods might go up just a little bit, just because they had declined so much previously that now there's a baseline that probably they'll go up a little bit, but it won't be anything that we would really notice on a grain scale. So you can't read it, but there's a little blue dotted line. That's Fidelity's estimate. The green line is the street estimate. So we actually think inflation might run a little hotter than what people are anticipating, but we don't think that's enough to derail the U.S. economy. And I mention that because if a report comes out that inflation is a little bit higher, the market could react to that. In our view, we're kind of expecting. So we're not going to be panicked by it. We'll actually use it as an opportunity to eventually invest where things get a little bit cheaper. But then payroll growth looks very, very strong from our standpoint. So it looks like this is a very good environment where the consumer is gainfully employed and likely continue to be able to spend money, which obviously propels our economy. This is a kind of an interesting one. I really kind of focus on the right-hand side. It's just a change in how things have worked over decades in terms of household wealth. And I think probably a lot of people in this room can identify with this. It used to be labor income was the biggest part of household wealth. How much people were making on an annual basis, which is the blue line, is the overall percentage of their net worth. The green line represents overall wealth, which includes things like stock market assets, real estate, so hard assets, and overall kind of wealth of a household, not just income. What we're seeing here is a huge shift. So people's wealth today is different than it was decades ago, where it's stored mostly in assets, stock market, and things like real estate, housing, and so forth. The wealth effect is real. When people have more money in their accounts, they tend to spend more money, and that's a good thing for the economy. You have corrections that can derail that a little bit, but we're less reliant on income to derive wealth, which is very important. And the wealth now in the United States is at an all-time high. So household wealth today is at an all-time high, which again we think will continue to help with spending. Oops. All right, I don't know if this is a concern to you, but we watch on a regular basis, which is, questions we get a lot are, yeah, but what about the overall market? Like, isn't it just tech that's doing well? Or the term Mag 7, I'm not sure if anyone's heard of that, but Mag 7 is the magnificent 7 large cap tech stocks that have been driving a lot of the returns. Think NVIDIA, if you've heard that name, is a good example of that, probably the poster child for Mag 7. What about kind of the breadth of the market? And what you see on the left-hand side is capital expenditures. So CapEx investment by Mag 7 companies is through the roof. That doesn't just help Mag 7. They're the ones that are spending the money. They're spending it in other areas to grow their businesses. So that is a very, very powerful tool to get more growth, AI, stuff like that. Think about artificial intelligence. That's where that spending's coming from, but it's going to impact lots of other industries and lots of other businesses. And a little trip through history here. The first graphic, the large green bar, you can see it is 2023, then the next section is 24, and then 2025. The green represents PE, price to earnings, valuations, basically. So coming out of 2022, when we had a big correction in both stocks and bonds did poorly in 2022, very rare to have happen. 2023 was a year where the market did really well. But it was all price appreciation, anticipating of earnings, but earnings really weren't there yet. That's true for certainly the Mag 7 tech stocks, S&P 500, X Mag 7 was the same thing. So excluding those stocks, it was all about being optimistic that there's going to be growth in the future. And then you look at 2024, the colors changed dramatically. 2024 was all about earnings. That means these companies actually delivered on their earnings that the market was expecting. And what do we have? A phenomenal year in 2024 as well for stocks. XMAG 7 was mostly still price appreciation, little earnings, which means the rest of the market really wasn't doing all that much in terms of earnings growth. But then you look at last year, 2025, now this is the Q3. We don't have the Q4 numbers fully in yet, but it's all blue for Mag 7. Every bit of the return last year in 2025 was from earnings growth, which is really good. That means the earnings were catching up to the prices. And then same thing with XMAG 7, S&P 500. So it means broader parts of the market. Think financials, industrials, healthcare are the other graphic on the right-hand side. They started to show some very strong earnings growth in 2025. Stock prices follow earnings is the point we're trying to make. So if you get the earnings right and earnings grow in the broad market, typically stock prices will follow that over time. There are periods of dislocation of that, but they historically do follow over time. So another question we get often is, but isn't the market expensive? We're at basically all-time highs. We've always been at all-time highs at different points in the markets, right? So it corrects and goes back and goes higher and higher and higher over time. We did a study back to 1950, seems like a popular time to start a study. And we looked at what the average 1-year return, average 3-year forward return, and average 5-year forward returns are when you invest at high points in the stock market. Most people would think, well, if you invest at a high point in the stock market, your returns are probably going to lower because you're buying high, and that's not necessarily a great time to do it. History would actually say it differently. So the blue, it represents investing in the S&P at all-time highs, or within 1%, technically, is the research. And then the green is investing in the S&P on all other days, not at the all-time highs. You actually did better at the highs, and the reason for that is momentum. Things tend to run in longer cycles over time. So higher highs beget higher highs because the economy is growing and tends to do well. So all we're saying here is it doesn't mean this has to repeat again, but just because stock prices are at all-time highs is not a reason to invest in stocks. And that is a question we get very, very frequently from folks. Here's another one. Forward returns when the Fed cuts rates near all-time highs. That's basically where we are right now. So the Fed clearly is pivoting, and they're going to be cutting rates. There's a big debate about how much they're going to be able to cut. It's a big debate about change in the Fed chair and everything else. But history would show that when the Fed is cutting interest rates and there isn't a recession, which is where we are right now, it's no recession, or Fed's cutting rates, and you're near all-time highs, these are the forward 12-month returns of the market. I'm not here to guarantee or predict anything, but what I'm telling you is 13 out of 13 instances that this has happened since 1950, the market's been up, and it's up on average 20%. So it's a good environment because earnings seem to be accelerating, companies are doing well, profit margins are very high, the consumer is healthy, gainfully employed, and you have a Fed that's pivoting from having higher rates down to lower rates, which is stimulative to the economy, and ultimately the market should reflect that. I may just kind of end here because I think I probably hit my time. And we're going to break out in terms of earnings revisions and margin outlook moving forward. So this is how companies are doing from an earnings standpoint. Parts of the economy represented by technology, S&P 500, and small cap companies, and then what the profit margins look like. The good news is they're all expanding. Everything's expanding right now. So you have tech. Last year grew at 27%. We think we haven't finished it yet, but roughly 27% earnings growth in technology. We think it's going to do 21% 2026. So down a little bit, but still growing at 21%. Very, very strong. The broad S&P 500, which includes technology, delivered. We think it'll actually end up delivering close to 13% this year. Very, very high. In 2025, we actually think it's going to be closer to 14% in 2026. So earnings acceleration in the S&P. Well, if tech is decelerating in terms of the pace of earnings growth, but the S&P is going to accelerate, what does that mean? It means we're getting growth from other parts of the market. Financials, industrials, kind of the value side of things. So your team here runs very well managed, diversified portfolios of growth companies, of value companies, of international companies, The broadening of the market is very good for these types of portfolios where more can participate within the overall portfolio that's been created for you. Small caps are expected to grow their earnings 41% this year. 41. Because it's off a very, very low base. They haven't done anything for years, but still, it just speaks to the strength, the overall strength of the economy. Solid earnings growth. This is not just a US story, this is a global story. Europe, other places are doing well here. They're cheaper valuations, and they're also all lowering interest rates. And I think, well, the last point I'll make is on the dollar because it affects international. Your portfolios all probably have some sort of international in them, some sort of global exposure. Last year, the US dollar declined roughly 10%, which is a huge boost to international companies doing business in US dollars. We actually think that trend likely would continue. So that's good for international stocks. When the dollar weakens, that's a good thing for both developed markets and emerging markets. We actually think international is going to have another good year this year. It outperformed the US last year, which nobody really paid attention to, but international had a phenomenal year last year. So I think I'll stop there, and then I'll have my esteemed colleague Dan come up. Yeah, there you go.
Thank you, Brian. You're back for another Brian.
No, it's more handle is the music one.
All good.
You know, we have an investment committee, as you guys know. We meet on a monthly basis. Of course, we meet the Carson. Thank you for your patience through that transition. But we still build our investment models independently. But one of the great resources at Carson is they have an investment department. So we have a team of experts, CFAs and economists who review our portfolios, which we build independently to give us some feedback. But fidelity is an important part of our mix. And I appreciate that. We actually had our investment committee the other day. And, you know, this is a very famous Harry Keller line, and I have lots of these. I'm sure Dan's going to ideally give some similar good news is that Brian's presentation was excellent. There's a lot of really good indicators this year. So as my dad famously says, we are really cautiously optimistic for this year. So I'm about to introduce Dan Miller. Dan has spoken many times at our economic forecast. He works at PIMCO, which is a world-renowned investment shop for fixed income. Many of your portfolios for well over 10 years have had PIMCO positions, and many of them still do. And just like I said with Fidelity, they're a great resource, a great partner, and without further ado, yeah.
Thank you all for having me and being here today. Looks like we beat the snow, right? You're not worried about that. It's great to follow Brian and such great company, Fidelity. As I'm back there listening to him, sitting there and saying, wow, we have a lot of the same views, our firms. You don't find that a lot when you get two different speakers and, you know, a fixed income heavy shop, equity heavy shop, but a lot of what he's saying, good views. So I'll hit on a few things as well, but as he said, you know, it's always hard to affect because he said a lot of things I would say, but I do agree too. The Saturday events, we would only do those for good clients. So I've been working with Harry, FIP, Jared for many years, I think 18 years now. So they're a great group. They really do planning. You don't find a lot of advisors out there and groups that do that. It's not about the performance, right? It's about being invested. We have a great slide I'll show you about emotional investing, things that you don't want to do, but this team really keeps you on track. So you can really, as Jared said, enjoy things and not worry about the money. So as you know, you're extremely diversified. 60-40 is essentially, you know, the benchmark that people use in the investment world. It can be 70-30, 90-10, whatever it is, but meaning you have stocks and bonds, and you know this would be considered a bond portfolio. But we'll talk a little bit about fixed income, right? The bonds in your portfolio. There's three main reasons people or advisors would use bonds for clients. Number one, income and returns, right? Bonds can provide you with a source of income, meaning if you need money to live off of bonds, pick out, or in a mutual fund or an ETF, a monthly type of return in yield. That in a lot of cases, you might be thinking right now, oh, wait, I don't see a check. Well, in most cases, it's just getting reinvested back into your portfolio. But they kick out something called income. They're a diversifier. I'll show you a lot of slides about how they diversify your portfolio, but they most of the time are non-correlated to your equity or the risk of your assets. Now, there can be times when they're correlated. Jared mentioned 2022. It wasn't fun for anyone. Stocks and bonds were both down. So, every few years or once in a decade or two, you can have them be correlated, but historically they're not correlated. And then preservation of capital, once again, because in most cases, bonds are less risky. Now, there's many different types of bonds out there. Some are more riskier than others, but in general, fixed income is used to preserve your capital, preserve your money. And once again, there's the charts, I believe, in your packets. So one of the things that's happening now out there is that people are sitting in cash. When I say cash, money markets, CDs, things that are not necessarily stocks, bonds, and other types of investments. We're actually at a record. Does anyone know globally, or not globally, in the US, how much is considered in cash right now? $8 trillion. $8 trillion. And I'm here to tell you, and I think Brian would tell you the same thing, is that cash rates are just going to go down. So cash rates, meaning what you get, right? We remember 10 years ago, you were getting very little. I remember I'd get like 5 or 6 cents out of my checking account. It was my quarterly dividend. But even money markets weren't paying anything in the last, say, 5 years. Money markets were at 5%. They were down to 4%. And now I think they're probably right under 4%. Fidelity has one of the great money market funds in the industry. But these cash rates are going to go down. They're tied to the Fed funds rate, which the Fed controls. And we know the Fed's been lowering rates and not as quick as the president would like. But as the new Fed chair comes in May, we would anticipate Fed funds rate to go down even faster and quicker. And the cash rates are tied to the Fed funds rate. What also happens when you're sitting in cash in a money market or CD is when those rates go down on a monthly basis, you don't benefit from that. If you're in fixed income or bonds, if your yield's going down, your price is going up. So your investments appreciate. So that's a great benefit to not being in cash. But besides all that, looking at the chart, what this is showing you, I think they were going back to 1950. 1947, if you invested $100 in bonds, cash, and then the rate of inflation is the lowest. Your cash would be worth $2,252. But if you were just in core bonds, you'd be roughly 4 times of what you would have been sitting in cash. Once again, our cash is around 8 trillion right now, so it's extremely high levels of cash. Cash has underperformed bonds by about 40%. So you beat inflation being in cash. That's great. But you could have done a lot better just being in fixed income. And that's what the green line shows. And as Brian mentioned, PIMCO believes as well that inflation should probably tick up a little bit in the next year or so. Nothing to be too concerned about. We have the same rate, roughly 2.7, 2.8 right now on inflation. But it could get a little bit higher. And Brian took another great point of mine, which most people don't realize. People hear inflation is coming down and they think that's price. Price is not necessarily inflation. That's not what the government's looking at. So to his point, food costs, prices won't come down. Gas, you can see, and Ryan and I drive a lot in our jobs. I'm always looking at gas prices. I had to fill up yesterday and I wouldn't go to the one by my house. And my wife goes, I've never looked at the price of gas ever. I go, yeah, I know. But and she's like, why are you going? It's 309. I'm like, yeah, but it's 293 down the block. So, she's like, and she's trying to calculate how much I'm saving. I'm like, well, something. But anyway, point being is, when you hear that inflation rates go up or down, it doesn't mean certainly on the downside that the prices go down, right? You're not seeing the menu items change. The price. So, inflation, as I mentioned, near target, but could potentially increase a bit. Growth, we feel pretty strong about economic growth, in the US certainly and globally. We're not calling for a recession either. Could growth slow a little bit? We think it possibly could. Once again, nothing to be concerned about. Why? Because that's tied into unemployment. Once again, you have 65, as Brian mentioned, 65-year-olds, baby boomers retiring at a rapid rate. I still think there's about 10,000 a day retiring. 50% of small businesses employed immigrants. 50%. We know, as he mentioned, immigration is virtually at nothing. That's legal and illegal. So, that's a lot of the workforce. You have AI taking away from jobs. So there's a lot of different things happening out there that, as you mentioned, the workforce might not be as many jobs needed, but if there are less people working, that could slow down growth a little bit. And then there's a lot going on with fiscal and monetary policy. Towards the end of the year, the big beautiful bill, BBB, they're calling it, did go through, but that will actually create some stimulus for people. This year, there's a certain amount of people that will get $1,000 check from the government. Once again, income, tax brackets, all that is tied into who will get it, who won't, but that could create stimulus. Why? Because we know, and this is, I know, contrary to what I said, there's $8 trillion in money markets, but as a nation, we do not save, right? If you give someone $1, they're spending $2. People spend, right, in this economy. So, giving $1,000 back to someone, chances are it's not going into the bank account. They're going to go spend it on their iPhone or something. Talk a little bit about Fed cutting cycles. The green line is the current cycle that we're in right now, which started, in 2024, so a year plus ago, a year and a half ago. But these are just different cycles. It's just trying to show that, over time, the Fed's cut many different ways. You've had immediate cuts, fast cuts, cuts that have taken longer. On the bottom is just how many months that rate cycle took. So once again, we're in the beginning of it. Why is that important? Because, as I mentioned, when interest rates go down, typically what happens when the Fed cuts rates, bond prices go up, which is a good thing because the value of your bonds are getting giving you more money. So Jared mentioned 2022 is a real year, certainly for fixed income as well, which is odd. But what this is doing, you can't see because of the zoom there. This is showing you the checkered is where yields were in those different categories and sectors of fixed income at the end of 2021, and where yields were September of 25. So a quarter ago. And yields have moved up dramatically, which is a good thing for you. It all happened though in 22, and that's why bonds were down. Once again, yields went up, the prices went down. Now we're in the reverse scenario where yields should go down and prices will go up. It was painful, it wasn't fun, but that all happened in 22. Since then, you've been collecting higher yields in your fixed income, meaning more money on a monthly basis into your portfolios. So it was, the example I would say is, it was painful. The Band-Aid was ripped off. We all felt it in 22. And unfortunately, that was also the year the stocks didn't do well. But the Band-Aid was ripped off. And since then, you've been collecting higher yields on your portfolios. Why are starting yields so important? Starting yield. So if something, and we can just take a treasury bond, 10-year treasury, let's say is yielding 4.2%. Let's say a mutual fund or an ETF you owns yielding 5 or 6%, whatever it might be. The starting yield is 94% correlated to your 5-year return. So if something is yielding you 4.5 today, it's a very good assumption that you will get that yield 4.5 as a return every year for 5 years. So starting yields are really important. It's a great predictor of your future return for fixed income. back 10 years ago, or 7, 6, 5, whatever it was years ago, yields were very low. So you weren't getting much return because yields were extremely low. But higher yields now are very beneficial. So once again, this example is 4.4. You can anticipate that type of return going forward. So whatever your investment is yielding today, you can anticipate that it should give you that type of return. So what has fixed income done? I mentioned 22 is a tough year. So from September of 23 to September of 25, so just in 2 years, this is the return of different fixed income categories. Really strong returns. To the left is cash. Once again, cash, you're okay. You're not going to lose most likely. You'll do okay. But in every other category there in fixed income, you've done really well. So you would have done okay in cash, but in a portfolio or having your money invested in fixed income and or stocks, you would have done very well. Once again, the group you're with, they have you in diversified portfolios. You own these types of sectors, maybe not all of them, but a lot of different sectors in the mutual funds and ETFs that are in your portfolios. So they're taking care of this for you. Here's another chart I find very interesting. So as I mentioned, starting yields are very anchored or correlated to your future return. So the gray bar across that you see, the gray line in the middle, is the average starting yield when yields are between 4 and 5%. The little blue dot is what you finished. That was your return. And as you can see, it's very close to your starting yield. In some cases, it's more, in some cases, it's less, but it's right by the line. So what's interesting about this is if you look to the bottom, these are rolling time periods with positive returns. So in the 1 year, 95% of the time, you had a positive return. For the 3, 5, and 10 year, 100% of the time, you had positive returns. And then on the left, we just showed you 3 months, right? That's a short time period, obviously. But even in a short time period, when your yields were starting between 4 and 5%, 72% of the time you had positive outcome. So once again, starting yields are really important. This chart is just showing you cash leading up to rate hikes versus after. Cash and things like that underperform leading up to a rate hike, but once the rate hike happens, you do get some positive returns. So what happens 1 year prior to a rate cut on the left? Those are different asset classes, and it shows you up top for fixed income. 1 year prior to the cut, so the cut started in 2024, you had decent returns, or you typically have decent returns. But what happens once the cuts start? 3 years after, so we're about 1.5 to 2 years after the cut just started. And once again, most people anticipate, especially with the new Fed chair coming in May, that you're going to start seeing more rapid and quicker rate cuts. You do very well on fixed income. So that's 3 years after the rate cuts started. In most areas of fixed income, you've done pretty well. So there's different types of cuts, as mentioned. The pink is showing you higher for longer, meaning very slow cutting rate cycle. The green is an immediate rate cut, where they keep cutting quickly, 25, 25, 25 kind of thing every quarter. And the blue line is like an emergency cut, like in 2007, they cut rates right away when we went into the financial crisis. Just kind of how your returns are. But once again, the point is it's all positive returns there so far, right? All the different asset classes listed, you've done well. We're not in an emergency cut. We're probably somewhere between the higher for longer. So, we've started that, but we're probably going to more quicker cuts, the middle there. So, once again, things look pretty good for fixed income. Another area that we like is municipal bonds. Once again, I know for most of you, I'm sure you own municipal bonds in your portfolios. The team does a really good job, as Brian mentioned, of diversifying you guys, very much so. So this is just showing you different types of returns. for muni bonds. Muni bonds are interesting because it's one of the only asset classes that's dominated by retail investors and mostly by US retail investors. And US retail investors, unfortunately, when you're not working with a team like you're working with, do the wrong thing. You panic. People panic, they see something go down, and then they sell, and they sell at the worst times. So that's what this is just showing you, is different flows. And what happens is, the line, the green line is, at the height of things, people just essentially are selling at the wrong time. So why is diversification so important? On the left there, the dark blue is the US, roughly a $59 trillion market, but it's roughly only 38% of the global world. We are in a global world, and once again, you do own global in your portfolio with FIP. But just showing you that different countries, and once again, that box is blocking the different countries. I mean, a lot of you have probably seen this with different asset classes and stocks and bonds, large value, small, international, emerging markets. This is showing you by country returns. And what we always say, or I always say, is like, just pick a color or two and look where it was like each year, right? You don't see one color dominating, always doing well, or one color, not doing well. It's about diversification, right? You look at the green, the Eurozone, some years it does well, some years it doesn't. Once again, diversification is key. So, when I was talking about when I started being non-correlated to equity, your fixed income, here's the blue is bonds, and the purple is equity drawdowns. So what we're showing you is, on the left is non-recessionary, which is probably, our view, and Ryan made this point, just because there's a recession, it doesn't mean bonds or stocks can't have good or bad years. So, even in a non-recessionary time, the market can go down. So in non-recessionary drawdowns, you see fixed income protected you. In recessionary, usually the drawdown you would think would be more, it is, and you would think bonds would do better, which it did. So bonds act as a ballast to your riskier assets. That's what it's trying to show. Once again, this is just from current valuations. It looks very attractive for bonds. So bonds can offer you an attractive outcome when stocks, we look at stocks and bond valuation going forward. Bonds look very attractive the way yields are right now. So this is one of my favorite charts, and this is why you work with FIP. The green line is a patient investor. That's you, because you have a great team here. The bars are flows, industry flows from Morningstar, which is a third party that looks at this stuff, meaning people adding or selling their portfolios. And the pink line there is the emotional investor, probably not working with a group like you are. And what this is showing is that the emotional investor underperforms the patient investor by a lot, right? Why? Because as you see on the bottom there, I can't take this anymore. The market's down. I'm going to sell. I got to get out. But what's the rule of selling, right? You don't want to sell low. But what happens is, as the markets are volatile, people sell. Now the green line went down, it went down, but they held on. They didn't panic, they didn't sell, and they ended up with a better result. So what happens is, oh no, I'm out, I'm scared, oh now the market's doing well. The market's recovered. Wow, the market's up 20, 30. Let me get back in. Well, you missed the bottom to the top, right? You got back in when things were up again. As I think Brian mentioned, you need to buy when everyone's fearful. When things are down, you want to buy. It's harder to do. There's an old saying, you want to buy when there's blood in the streets, especially when it's your blood. Like even if you're down, you got to buy more, you got to add. That's when you want to buy. When things are great, you don't want to sell it at the bottom and buy it at the height. And as Brian mentioned, not to say that things don't go higher, they do, but you miss a lot of the return. So that's what this chart's showing. Just you need to be patient. You're working with a great team. They're using software. They're mapping this out. They're taking conservative views for you. You'll be fine. And not to say it's not scary. I get it. It can be, but you just have to stay diversified, invested in active managers. And here, this is just showing, bonds are different in active management. So there's a lot talking about passive. Passive is just when an index is bought and they don't do anything. It just keeps going. Well, in fixed income, 87% of fixed income in the core and core plus categories, 87% of the products out there beat the passive. It's a lot harder to do in equity. So in large cap, only 13% of active managers beat the benchmarks. It's a harder thing to do. There are great managers out there like Fidelity and others, and PIMCO has some equity where we've beaten it, but it's a harder thing to do. In fixed income, it's an easier thing to do. I would say that's pretty much it. I don't know if we're gonna do a Q&A now, Sarah. Yeah, briefly.
Thank you, Dan. Great job, Dan. Okay, so. Who wants to remember everything that he just said? Who wants to go book vacations, play pickleball, and have all the fun that they want in the world over learning every little thing that Dan just reviewed, which was tremendous? That's what I want for you guys, and that's why we're your trusted partner, because while you're having fun, which I need you, I say this over and over, while you're having fun, enjoying your life, these are all the things that we are studying, and guess what? I need Dan and I need Brian, because you think I remember everything he said? No, but we have great partners. So our investment committee meets on a monthly basis, so all that knowledge that we just got, we meet monthly to review. I know you guys probably want the recording so you can study it, but I'd really rather have you doing fun things and know that we're the ones taking care of all the changes in the market and the economy for you. That's what we're here to do for you guys. Before I ramble for another 9 hours, we're gonna bring Dan and Brian back up for a little Q&A. I'll run the mic around. Any questions for Dan or Brian? Oh, is there a Zoom one? I'm sorry. What do the bond people say? Dan, if you want to have a very simple, quick outlook, bonds are up or down.
Yeah, so as mentioned, starting yields are very important. There's very high yields now, decades high. It's extremely important because that is highly correlated to your future return. So things look extremely good for bonds.
Awesome. Questions in the audience? It's funny, I had a list of stock questions and they of course covered every single one of them. Is there any challenge, hard ones? Oh, there we go. I'll bring you the mic.
All right, so it's funny, good timing. I was on a call yesterday with 5 of our growth portfolio managers at Fidelity. We've been intimately involved with researching, studying everything about AI for the better part of decades now. Because AI has been around, but now obviously it's catching steam. Our thesis is that AI over the next 10 years is going to add significant productivity to companies. So it's a long-term deal. I know you're asking the next couple of years. It's here to stay. Companies that are adopting it at a rapid pace, because it's like an arms race right now. Everybody needs to be at the top of their game as it relates to artificial intelligence and how to make their businesses more efficient. We won't know for years in terms of who's done it well and what industries are going to be impacted the most. Our guess are things like industrial companies where there could be more efficiencies wrung out of industrial companies. Healthcare and biotechnology are huge for artificial intelligence. You think about the power of the compute systems to discover and resolve today incurable diseases and what artificial intelligence might do for that. It's enormous. So what we're trying to do at Fidelity is trying to figure out what companies and what industries are going to win in the long term. In the short term, You've seen a huge run up, obviously, in the semiconductor companies, semi-cap equipment companies, NVIDIAs and the like. That likely will continue. There's froth in the artificial intelligence world, just like there was in the internet world back in the late 90s. And we didn't know really until, 5-10 years later in terms of how all that was going to shake out, who were the winners. And it actually, the internet boom created a whole new industries that we didn't even contemplate back then, but now exist. We think AI is going to be the same thing. So we're trying to be very prudent about what companies are going to win out here. And companies that are over levering by spending too much money on AI, we're also very cautious on. So I won't name any names, but there's some that have levered their balance sheets very, very hard to spend on AI, took on a bunch of debt. That's not what we want. We want companies who are going to be able to figure out industries that can have how to harness this to make their businesses more efficient. And ultimately, we don't think it really replaces a lot of jobs. There are some jobs that will be replaced clearly from artificial intelligence, but we think it's going to be more additive and adding more towards productivity of these companies and industries more than this. We're very bullish on AI. We're just careful about what we're putting and deploying our money at this point. And it's a lot in the semi-cap equipment because you need power, you need the compute power to do it. You also need energy to funnel it into fuel. So I'm talking about like utility companies and the others that there's massive power demand here in the US driven by AI demands. There's a whole sub business that's happening right now with nuclear and everything else. It's a big thesis. So it's not just AI tech companies. It's what that's going to mean for all sorts of industries. That's kind of how we're thinking. We're very bullish on it, near term and long. Yeah.
Okay. We agree everything with what you just said, but one thing that we talked about is that for the consumer, it's a K-shaped economy. I don't know if you've heard that term. You look at the letter K, some consumers are doing well, probably most of you, right? If you have financial assets, you've done very well. If you don't have financial assets and, are on the lower scale, it's been very tough because of inflation and prices. But we say it's the same thing for companies out there as well. There's going to be the ones that are doing the right things with AI and a big part of our growth, economic outlook of growth is because of AI spending. It's that big that it's helping the economy. But to Brian's point, there's plenty of companies that you don't want to own. And that's why whether it's, 50 would say fixed income or stock, you got to be active. You don't want to own an index because there's plenty of AI stuff you don't want to own because some of these companies are not going to do well with AI, their spending or whatever, or they can't do it. And there's others, on the bottom part of that we will suffer.
How do you think the market will respond to the Supreme Court's decision coming up on the tariffs?
I was hoping we could avoid that. I was hoping we're going to avoid any. It's not politics, but it's a legitimate decision they have to make. I don't know. I mean, what's been bullish for the market thus far has been the massive reversal in the trade deficit, which is largely due to the tariffs. So there's a 60% reduction in our trade deficit last year because of the trade, because of the tariffs. So they had the tariff tantrum right in the beginning of the year where the market just couldn't digest what was happening. Everything was being disrupted. Talk about a quick drawdown of over 20%. That happened right in the spring of last year, April of last year. What the market do afterwards, when he started to renegotiate, it just took off. There is talk internally at Fidelity. We have a huge army of legal folks within our firm that are also down on the Hill and lobby and everything else. And they're coming back to us and saying there are avenues to be able to administer similar restrictions like the tariffs and still get the income aside from how Trump's done it. So there are other paths that they can explore to do so. They're a little more cumbersome to do. If I had to guess, and it's a guess, Left probably does not react very favorably to that because the amount of money we've taken in as a country to offset our trade deficit. That's a negative. Long term, we think it's a solution for that. It's just going to take a little longer to re-implement the tariffs in a way that's compliant. So it's
Yeah, no, we pretty much just agree with that. The other question which I don't have an answer for is, do you give back the money? Like what happens with the money that was collected? Like it's very complicated, but we would agree that certainly short term there could be some volatility around.
But, same thing, we have people in Washington for our company all the time, and there seems to be still other things that can be done, but we'll just see.
We have a Zoom. All right, he's muted. Oh, Arnie, you're muted.
Yeah, I'd like to ask each one of both Dan one question and Brian another one. One is there any room for sector rotation when we go ahead and talk about our investments in mutual funds? And for Dan, I would be interested in finding any information about market-linked notes, US versus Canadian.
I got an easy one.
Yeah.
I got an easier one. The question is around kind of sector rotation. I don't know if this exactly answers your question, but we do believe there's a rotation occurring today. And I mentioned this a little bit in the presentation, where the market returns really largely been driven by the big cap tech companies, next 7 companies. But what we started to see in the fourth quarter, and we're definitely seeing it so far this year, just the first 3 weeks of this year, is a pretty significant rotation away from tech, but more towards cyclical, what we call cyclical values. Industrials and financials would be the biggest two. Kind of think about like nearshoring and onshoring of our production. Think about owning a little bit more of the supply chain here in the US, not being so dependent on other countries. That's the industrial theme. And financials, someone needs to fund all of that. So that's a big piece of it as well. That's already happening. Your portfolios already have that in there though. So like the value holdings that you have in your portfolios, they're going to be more exposed to those areas. So you're going to have financials and industrials and healthcare, maybe utilities and staples and some other things in the value side of the bucket. So you already have exposure there. So that's why running diversified portfolios, you don't necessarily need to shift heavily. But there are definitely opportunities. And I would tell you, we're very much a growth company at Fidelity. Even in our growth portfolios, we're shifting more towards some of those sectors internally for the mutual funds and ETFs already. So we see this opportunity there, and we're making that movement.
I don't have an answer for you, unfortunately. So we don't offer those types of products at PIMCO, so I'm certainly not an expert on it. But I can tell you, as I think Brian mentioned regarding the dollar, you saw roughly about a 10% weakening. We continue to think the dollar weakens, probably not to that extent. But we do think which leaves opportunities in emerging markets and other areas. So yeah, unfortunately, I can't answer on those products.
We can follow up on it, Arnie. Carolyn?
Okay.
Yeah, so the question is kind of the geopolitical conflict, correct me, Carolyn, this is wrong, but geopolitical conflict and how that may stress the current position as the US dollar being kind of the global currency and global standard. We don't think there's really much risk to the US dollar being removed from kind of the gold standard for the world. There's really no alternative. And you can look at what the euro, we don't see that as being a viable option. The yen, no. The yuan in China, no. So on the margin, we think the dollar remains the currency of choice. Now, does it weaken here a bit? Yes. So we do think the value of that, because it's a 2-standard deviation difference high from where it normally trades versus a basket of 20 other currencies. So the dollar's expensive right now, and we actually do believe it will migrate down south, but that's not going to challenge its dominance as the global currency, because there is no alternative that really any country wants to adopt at this point. On the margin, there was that discussion about like countries banding together and kind of creating their own version of a global currency. Never happened. It's just 95% of the trade happens in dollars. That's likely to not change anytime soon. So we're not worried in the immediate future, next 5-10 years, of the dollar losing its status as being the global currency. Could anything happen? Sure. We don't see it. We do see it weakening, but that's more getting back to more normalized valuation.
Yeah, we would echo that 100%. There's just nothing else out there. I remember bunch of years ago, the thought was one of the Chinese currencies. And I remember actually I was doing either this event or their other event, at FIP, right when China devalued their currency overnight. I think that was 2017 or 18. And I remember saying, well, there goes that, is, that's no longer gonna be a reserve currency. And then the other one, or things that was talked about, right, in the last few years was, Bitcoin or some stable coin, or, but we've seen the volatility there, we've seen, problems there, so we would agree that there's just nothing to dethrone it right now. And in the foreseeable future, we're still the US.
Any other questions? Okay. Good, more questions, better.
This isn't quite, wonderful feedback, but it's in the field. With AI coming on board and using up so much electricity. On Fox News the other day, I was watching a company that exists. And Elon Musk is starting his own where they want to capture the energy of the sun and bring it back. Is that something that you would follow and get invested in?
Talk about, yep. Okay, so, question was about harnessing the power of the sun, Elon Musk, potential company to try to figure out how we're gonna provide enough power for all of the large language models and artificial intelligence, power demands that we have here in the United States. I was on this growth panel that I was on yesterday, for Fidelity, had all of our, portfolio managers there. These are folks, by the way, that have private dinners with NVIDIA, have private dinners with all the major executives on a regular basis. So we have some really good real-time intelligence. Musk in particular is a frequent flyer to Fidelity. So we meet with him and his team very frequently. Interestingly, they're test piloting today mini power stations up in space. So what they're doing is they're launching mini power grids, kind of think of it that way. Not huge, not like the big data centers and warehouses that we are building here in the United States on land, but they're shooting them up into space to see how effective they can be about harnessing power. And also, don't forget, it's very cold up there, which is what we need. You need cooling, which is kind of the thesis behind this. And we think there's a potential of a real business with this. And so we're thinking it from an investment standpoint, obviously, but we're thinking with the SpaceX, which Fidelity is a huge owner in SpaceX, by the way. We think there's a good chance that has a viable output to be able to harness energy in outer space to transmit it back to the Earth, to then for companies to be able to use. It sounds outrageous. But in a very, very futuristic, but we're pretty much here at driverless cars, and nobody thought that was going to be available 20 years ago. We kind of thought there was a chance for it. So this is a very real possibility, and so it's very early in its testing right now. And SpaceX clearly is in his companies, not just SpaceX. SpaceX is what gets it up there, but are at the forefront of all of that. So it's fascinating. The reality is we need more power in the world. We don't have it. We need it in lots of different forms. That's why you're starting to see a real push towards nuclear and other things. But this is another version of that could have very, very meaningful impact. And there are a couple of companies, Musk clearly being the biggest one. It's kind of spearheading this. So we actually think there's viability to this in the long term. Yeah.
Any other questions? Zoom? Great, thank you guys again. Wrapping up. I love these questions because I know you get a lot of great information, but it just gives me and hopefully you more confidence. And we talked about how our portfolios are, as you know, allocation models, everybody goes into our models. Whether you have 100,000 or several million, or even your children starting out, they all get our best ideas. And what I love about these models is addressing a lot of the question you're asking. Over in sectors change, how do you change? Or what's going on with the dollar? our strategy is I'm not gonna present myself to be the expert. We hire the experts for you. We have Fidelity, we have PIMCO, we have State Street, we have First Eagle, and all these great funds. We hire the experts, put them together, and have a great diversified portfolio, but not just the investments, the strategy. You don't have only how Fidelity invests their money in their strategy. You have multiple different ETFs and mutual funds with different strategies, all trying to get that good allocation that we have set for you. So we diversify this in the internal investments and then the strategies. And also, if you do look under the hood, how much tech do I have? Do I have too much tech or financials? We monitor that as well. So what I love about our models, in and out, okay. What I love about our models is what gives me confidence that we're taking the best care of our clients and making sure you have great managers and great underlying performance. So thank you guys for joining us today. I hope you had a tremendous time, great food, great presentation. As always, your relationships with us mean the world to us. We take care of people for a living. So standing in front of a room of people who we truly help have a better life, there's no greater reward. As always, what am I going to say? I always say this to my clients when I'm wrapping up my review. We're looking to grow our practice. So if you do have friends, families, children, coworkers, they are going to get the same high level of service and experience that you guys get. In addition, there's a evaluation form. I should have said this at the beginning. I apologize. If you could briefly fill that out on Zoom, you'll be getting an email to you. We love your feedback. Our goal is to constantly get better for you. So any feedback we can get would be really important to us. But otherwise, thank you so much for your time. Everybody stay warm the next couple of days. Go to the grocery store. Never forget.